Hey everyone, and welcome back to the weekly chart wrap by True Options Masters. I'm Mike Merson, your managing editor, and in this weekly video, we're going to take a look at all of the charts I looked at in our usual chart of the day sections at the end of each issue. If you like this content, be sure to give it a thumbs up, be sure to subscribe. That is the best way that other fellow option traders can find our content on YouTube. And if you're not subscribed to the True Options Masters e-letter, you're going to want to do that right now because we have amazing content coming out every single weekday. Trade ideas, charts to watch. I think it's the best options e-letter anywhere in the known universe, if I may be so bold. So, without further ado, let's get right into it. We had a lot of fun stuff we were looking at this week. I don't think I want to start on commodities, though. Let's start with where we were on Monday. If I can just... here we are. Good old Tesla. Alright, so let's just see where we're at with Tesla. Elon was up to some antics over the weekend. He made a Twitter poll saying he is not a fan of these unrealized capital gains tax that's being floated by the White House. I can't say that I am either. I don't think it makes a whole lot of sense or incentivizes investment in the country, but that's besides the point. Right here near the tippy top, after a rip, roar, and run that Tesla's been on for the past few weeks now, it feels like, Tesla basically dumped as low as 21%. And it was really only sparked by this move by Elon, because you got to figure the 8th was Monday. This was how the market acted in response to this news from Elon. And then it really carried through the next day, Tuesday, after getting bid up a little bit on Monday. And it's recovered quite a bit here. We're hanging out. We closed today at, what's that, 1063? We're trading a little bit lower in the post market. I said on Monday that I believe the stock is going to bounce here. It definitely did that day. Tuesday came a lot more carnage for the stock, but we're bouncing yet again. It's been really hard to bet against Tesla for a very long time. A lot of professional investors have lost their shirts betting against Tesla. Michael Burry of the Big Short fame, the guy that's supposed to be pretty good at shorting stocks. I mean, he was shorting Tesla. Probably like down here somewhere, right before it broke through this key yellow horizontal resistance I have, and what looks like a downtrend I was playing with, yeah. Chris Samarelli, your publisher, was putting on shorts on Tesla way up here. I'm not sure how those trades have gone. I know the volatility in Tesla options can really make things screwy for that stock. So shorting Tesla, I would say that's for the brave. I also have to say that you want to buy Tesla on the dips. Yes, the stock is wildly overvalued. Yes, it makes up a huge portion of the S&P 500 relative to the other stocks. And obviously, it's led by a CEO with quite a track record for surprising folks in ways that maybe aren't good for the stock, but it has persisted. And I don't own Tesla, but boy, I'd be happy if I did. Even after this week, even if I owned it just like a couple months ago, I'd be very happy because I'd be up very, very nicely. So Tesla is naturally always going to be one to watch. I think Tesla sees new highs. I know it might sound crazy to you, but it's narratively, it is such a strong stock and you can't discount it. It's resilient. It needs to be at least on your radar. If you're not brave enough to buy it and you're not brave enough to trade it, I wouldn't blame you because the volatility makes those option premiums so costly. It's at least one to have on your watch list, and it will definitely remain on my watch list. If anything screwy happens with Tesla, I'll definitely keep on writing about it. So speaking about screwy moves, the S&P 500 had a week. So if you've been following along, even in my most recent chart wrap video, you know that I've been watching this very long-term trend line going all the way back right after the first pandemic bounce, which is right around here. Let me just hide this volume real quick so it's out of our way. And you can see that the S&P has been very, very obedient with this line over time until we finally broke right around here in September. We fell, we bounced, we fell a little more, came up against this horizontal resistance, came all the way back up, broke through. And last week I pointed out I thought we might retreat from this level here. But we broke right through, but we also broke right back down again in the volatility this week. So what to make of this? I mean, was this a fake out back above our long-term blue trend line? And this retest turned into a retreat from the blue trend line once again? It's certainly kind of seeming that way. We have a MACD bearish cross right about to form here on the daily trend. So this is suggesting at least a little short-term volatility in the coming weeks. But let's take a look at it on the weekly. So if you're not aware, we use, excuse me, I'm trying to get rid of my my pen tool here. I can't seem to do that. All right, I'm not too worried about it. A weekly time frame means that each candle on the chart is plotted every week. And so it's helpful to look at charts on these various different time frames because they can essentially show you different pictures. Weekly patterns are going to play out over months and even years, while daily patterns are going to be a little bit more short-term, hourly patterns even more short-term, and so on and so forth. You see it goes all the way down to 1 minute here on my toolbar. And you can confirm, you can configure it with all sorts of different custom time frames on your charts. So, where do I think the S&P is going? Just based on the look of the daily chart, unless we mount a really big bounce here, I think we might head lower for a little while. We have this yellow horizontal down here to catch us. There we go. That got rid of my, that got my cursor back. But I think you want to be a little cautious in this environment. Definitely not overly bearish. As we know, it hasn't paid to be a bear, like I said in my last video, over the past few years. And with the pretty accepted knowledge that the Fed is going to raise interest rates eventually, probably sometime next year, in the market not really panicking too much in light of that, I think we trend higher. There's a lot of reports that 40% of all currency has been printed in the last couple of years. That money's got to go somewhere. And with yield so low, both in government bonds and now in corporate bonds, there's almost no good place to put your money except a stock market. It's definitely not good in a bank and a savings account earning 0.000 whatever percent. And it's definitely not beating inflation in the bond market either. So I think stocks are going to continue higher. I still believe Mike Carr's prediction of S&P 11,000 by 2024 is legit. All right. And everyone that's watching this should be preparing for that scenario. And they should be preparing for that by investing whatever extra cash they have, and definitely not keeping it in a U.S. savings account. So let's talk about inflation. Inflation print came out on Tuesday at 6.2%. That's 6.2% year over year. That was the non-core CPI. It includes food and energy prices, which are volatile, but are also key to everyday people's expenses. So why that's excluded from the so-called core CPI, I don't know, but that's the picture we're looking at. Things are more expensive. Fuel's more expensive. Food's more expensive. And likewise, stocks are more expensive. Bitcoin's more expensive. Gold is more expensive. It's all this extra money is sloshing around into these assets. That can be a bad thing for everyday consumers, but it can be a good thing for investors. So with this in mind, we have to ask ourselves, why is the dollar chart doing this? This dollar chart looks so bullish. We have a downtrend break. It was a consolidated break, I'll give you that. But we certainly held this yellow line that's held us up for quite some time now. And now we're trending higher. We have like a pretty clear series of higher highs and higher lows here. So how can the dollar trend higher in an inflationary environment? Well, it really kind of, you got to think about the cyclical nature of asset allocation. So when interest rates, let me start with inflation. When inflation is hot, the Fed's main way to combat that is with raising interest rates, okay? When interest rates go higher, you want to be out of risk-on assets. Things like stocks like Tesla that don't pay a dividend, but that you expect to go higher over time. Because when there's no yield, that's really the only way to grow your capital. But when there is yield, there are much safer ways to grow your capital. So what happens? People sell their risk-off assets, like we saw this week in the market and with Tesla, and they hold dollars. And the more people hold dollars, the higher the dollar index rises. So just some context, the dollar index is a sort of the dollar against a basket of other currencies like the euro, the yen, the Kiwi dollar, the Aussie dollar, a lot of other major currencies, the renminbi from China. So that's why you actually conversely want to be long the dollar in this environment as well. I've been calling for a strong dollar for the past few months, and that's mainly because of this Euro USD chart that I've been screaming about. Let's take a look at this on the weekly. It's just a little bit easier to take a look at. Talked about this last week. We have a head and shoulders pattern playing out very, very nicely. We broken the neckline, and we are having yet another crappy week for the euro. Euro's trending lower. I fully expect it to go all the way down to this 1.10 level that I've been talking about, and that signals a very, very strong dollar, at least through the end of this year. So if we're going to talk about inflation, we also have to talk about Bitcoin. Bitcoin had a weird week. Narratively, it behaved very strongly after that CPI print. So let's bring it back to the 1 hour just to get a better look at this. CPI print comes out right about here, right? Bitcoin trading about 66K, sort of waffling around here. Big rally off that CPI print. Bigger rally the next hour, kind of carries through, looks like it's going to bust higher, and then we just give it all back and then some. And now look where we are today. We're lower than before the CPI print. So Bitcoin's a young asset, right? Narratively, it wants to be an inflation hedge. But I think what this week has shown us is that Bitcoin's still a risk-on asset. It's not yet proven. Not yet proven enough to be a proper inflation hedge. Maybe that changes over time. I don't think you want to be necessarily too bearish on Bitcoin here. It's by no means my biggest crypto holding, and not the one that I think has the longest legs in terms of time, in terms of long term. But it's certainly not a bad asset to hold through the rest of the year. I think it reaches 100K this year. If not this year, then early next, with the potential blow off as high as 200K. So that's what you want to be planning for. If you hold Bitcoin, you want to start selling it at the 100K handle in tranches. If it goes higher, sell a little more. If it goes higher, sell a little more. So let's talk about Bitcoin's much, much older, much, much more established cousin, gold. If I can find it here on my massive chart list, gold. There you are. So look who did hold on to their gains after the inflation print. Inflation print was right about here, as we can see. Huge rally in gold, huge follow through, a little bit of consolidation, and where are we today? We're right back above at those high levels. So gold is really carrying it through here, and to me, this looks a little bit like a nice ascending triangle. You bring all this together and, well, we could potentially be breaking down, but that's a sloppy triangle. And then, boom, we have like nice, fairly horizontal resistance. So if gold doesn't fall apart here, reclaims its triangle and runs higher, then things could be really, really nice for gold bugs for a little while. And I also like to point out, just because it's here, we have a nice downtrending channel in gold that I've been watching for quite a while now. And it looks like we just broke it with gusto after holding this yellow horizontal for a really long time. Silver? Might as well take a look at silver too. Silver also breaking downtrends. We had a positive divergence on the MACD and the RSI. Let me just point that out a little more explicitly for you. Boom, and boom. Check that out. So I talk about this a lot in Chart of the Day. When you see lower lows on an asset, while the momentum indicators, the MACD and the RSI, make higher highs, that's a signal to get bullish. And what we're seeing here is that played out perfectly. I mean, we had a lower low in silver with a higher high on the MACD. And what do we have now? We have a silver breakout. I think it's a beautiful thing. So the precious metals bugs might actually get to finally be happy, because gold has done a terrible job with the inflation narrative this year. Anyway, so since we're talking about gold, silver, Bitcoin, we might as well look at the entire commodities picture. And what I wanted to really do was compare this to the S&P 500 this year. So forgive me, I'm just going to try to put this together real quick. Let's go ahead and make this a line so it looks a little less ugly. So let's bring it to a daily chart. Okay, so we have DBC in the blue line, and we have the S&P 500 in the orange line. And what we can see is that S&P 500 had a pretty good year, right? Going back to, let's bring it to 2021 here, up 25%. Pretty good, until you look at the commodities picture. Now, DBC is a basket of commodities. I wish I could tell you with confidence what precisely it holds. I'm going to say gold, silver, copper, maybe platinum, palladium, maybe a little oil. But what we're seeing here is that DBC has done almost double the S&P 500 this year. Commodities have beaten stocks. Now, that's due to a lot of things. That's inflation, that's supply chain. And if you ask the White House, the supply chain issues have caused the inflation. I don't know if I'm so convinced about that. But it's clear to me that we're in a commodities bull market here. And you want to be long gold, silver, oil, copper, platinum, palladium, these major industrial and precious metals and commodities. And I think this lasts for quite a while. Commodities have been in a bear market for a very, very long time that I think we're just now escaping. So that's going to wrap it up for this week's Chart Watch, or Chart Wrap. Should probably get the name right. I appreciate you watching. And if you like this content, I said comment last week. I don't know if anyone caught that. If you like this content, be sure to give it a thumbs up. Be sure to subscribe. Be sure to keep reading True Options Masters, the greatest option trading newsletter in the known universe. And I hope you have an amazing weekend. I'm Mike Merson, your managing editor, signing off. And we'll be back to you next week. Thanks so much, everyone.